The New York City Transitional Finance Authority, TFA, is one of the largest and most successful municipal bond issuers in the United States. While it sounds like a complex financial entity, its purpose is straightforward. It was created to help New York City borrow money for infrastructure when the city reached its legal debt limit. The TFA was established in 1997 by the New York State Legislature. At the time, NYC was approaching its constitutional debt limit, which threatened its ability to fund critical capital projects like schools, bridges, and water systems. The TFA was created as a separate legal entity from the city. By issuing its own bonds, backed by NYC personal income tax and sales tax rather than general property taxes, it allowed the city to bypass traditional debt limits. Following the September 11 terrorist attacks, the TFA's authority was expanded to issue recovery bonds to finance the massive costs associated with the disaster and the city's recovery. Although named transitional, the TFA has become a permanent pillar of NYC's financial strategy. As of 2026, it manages tens of billions of dollars in outstanding debt and consistently maintains high credit ratings, often AAA or AA1. Investing in the TFA primarily means buying municipal bonds. These are essentially loans you provide to the authority in exchange for regular interest payments. The most common way to profit from TFA bonds isn't just the interest rate, but the tax savings. For a New York City resident, these bonds are often triple tax exempt: no federal income tax, no New York State income tax, no New York City income tax. For high-income earners, a 4% tax-free yield might be equivalent to a 6% or 7% yield on a taxable investment. The TFA does not sell bonds directly to individuals via a storefront. You must use a middleman, brokerage account. You can purchase new bond issues, primary market, or existing bonds, secondary market, through firms like Fidelity, Charles Schwab, or Vanguard. If you don't want to buy individual bonds, you can invest in a New York Municipal Bond Fund. These funds pool thousands of investors' money to buy a variety of NY bonds, including TFA bonds. Purchase a bond at par, collect the tax-free interest for 10-20 years, and get your full principal back at maturity. If interest rates in the general market fall, the value of existing TFA bonds with higher rates rises. You can sell your bond for more than you paid for it. Buy bonds that mature at different intervals to protect yourself against interest rate fluctuations and ensure steady cash flow. While TFA bonds are considered very safe, they are not risk-free. If market interest rates rise, the resale price of your bond will drop. If inflation is 5% and your bond pays 3%, you are losing purchasing power. Since these bonds are paid back by NYCC income and sales taxes, a major economic downturn in the city could theoretically affect the authority's ability to pay, though this has never happened.